anyone else that can hold through this part of the cycle is typically holding. So the opportunities that are coming along are what we're seeing are in many cases a little bit juicier than they have been in the past from an upside potential standpoint.
Welcome, Real Estate Hustlers Podcast. I'm your host, Josh Appelman. Today we are joined with Ivan Barratt, CEO of BAM Companies. He's raised around $500 million worth of capital, acquired 9,000 units, and led $1.7 billion in deals, specializing in large Midwest multifamily. Ivan, we appreciate you coming on the show today. If you could let the listeners know a little bit more about yourself.
Yeah, Josh, thanks for having me. It's great to be here. I've been looking forward to this one. So been in real estate now 25 years, basically from the start of my career through today. And as you mentioned, we've been involved in, about 9,400 units across development. We're multi strategy fund manager now, but our foundations are in property management. In 2010, I started my own company after leaving my mentorship with my real estate dad, my first real estate mentor, and started small as a property manager, buying small assets myself, but also doing a lot of third-party property management for investors around the country that were buying duplexes, single-family homes, and small apartments here in the Midwest. We used that management company to grow our own syndication platform. And once we had the track record and a number of exits to show proof of concept, we used that to build a fund management business. And now we're in private credit, acquisitions, and development.
Wow, that's cool. And you've always been an operator. All you did was change the way that your business operated and started being an owner-operator.
Yeah. We started real small with big ideas and have continued to layer on that original company into what we are today. But we've always been on the operating side, realizing early on in real estate that execution's the name of the game, and wanted to build a really good infrastructure for executing. In many ways, it's simple and maybe even a little bit easy to go out and do real estate deals, but to do it right and execute after that closing takes a lot of human capital and desire to win.
Yeah, that's right. And to execute on a business plan and see it through to the end and go full cycle, it takes a different type of person, and to make sure that everything falls in place. Which it doesn't always fall in place, but as long as you get there along the way, you're gonna have your challenges. Tell us about the first deal. You were doing your operations, you were a property manager. Tell us your first deal of when you purchased it, 'cause you already had a property management in place. Tell us how you found it and what made you pull the trigger.
Well, maybe we'll talk about a different deal. The first deal was a duplex. I house hacked. I lived in one side and rented out the other. My father had given me Rich Dad Poor Dad a few years before. He had owned rental properties and said, "Hey, if you want to buy a single family house and live in it, you're on your own. But excuse me, if you buy a duplex, I'll match the down payment."
Nice.
And that was the first start. From there, I started using hard money to do my own deals, small multifamily assets. But I realized I could grow a management company a little bit faster by offering those services to other investors.
It's tough to offer those services to other investors when when you're not the owner there too, because then you're only getting paid by the fees you charge.
Choking on my own spit here.
But changing over to where you're owning the deal and operating it, it's a whole another ball game. You started small. You were already operating. Tell us about the first when you decided to scale and your first big, larger multifamily deal.
Well, it's a progression, right? So I had maybe 18 units, duplexes, and let's see, a fourplex, some smaller apartment deals, and jumped from there to buying a 35 unit and a 30 unit and a 15. Those three assets were simply an investor and an operating agreement. And then from there, my first syndication was 60 units. And I was able to show that business plan to some of my early management clients who I was managing their duplexes and small apartments. And they took one look at the business plan for a 60-unit deal and came on board. And then from there, gosh, we went to 97 units, 112, and then jumped up to 237. And those early days, I was in charge of raising the capital. By then, my partner had come along, who's a much better operator and manager of people than I am. And it was his job to find the best real estate deals. And he had a knack for the management of the team, the leadership development of the people underneath him. And so I stayed out of his way on the management side and really focused on our equity side, being the best partner we could possibly be to the LPs that came alongside us. And I've just continued to try to be a little bit better every day than I was the day before. And that's grown now to 1,700 investors across, gosh, I think we've done about 43, 44 deals so far across acquisition and development.
Wow, that's incredible. And it all started small, and then what made you want to find a partner? What made you want to? Because you're scaling, obviously you need people to scale, but when you bring in a partner, that's a big deal.
Yeah, as a founder, I started really looking at what I was really good at, what my gifts and talents were, and recognizing that there were a lot of gaps there, and what it would take to fill out a complete a business, a complete team. And I learned early on, know thyself, right, and focus on what I could do really, really well and my strengths, and find other people that were strong in those areas that I'm weak in. And it started off real simple. Hey, let's go put a deal together and see how we like working with each other and see how this works. And gosh, it's been one of the greatest blessings of my business career, probably right up there with my spouse, my wife. And together, the saying goes, the whole is greater than the sum of the parts. And so it's worked out really, really well for him to focus on what he's good at, which is the operations, the execution, the management and leadership development of the teams. And I know that he's going to take that baton and run with it while I'm over here on the other side, focused on getting the equity in the door.
So what happens if you can't get the equity? Because it's different times. Equity's tough because there's a lot going into AI, a lot on the sidelines, a lot
Sure.
waiting on. I mean, because that's your part of the deal. I mean, I guess you just got to dig deeper, right? Make deeper.
Yeah, I'd be lying if I said it was easy. That's for sure. We've entered the third time in my career where it's harder to get the equity and there's more opportunities available. And so we've had to work twice as hard to raise the same amount of capital. We've raised about 250 million since January 1st of 23. Really the valley in the cycle. And it's been a great time to buy. It's been a pretty terrible time to sell real estate. I think we're coming out of that. Luckily, we've got the balance sheet and the liquidity and great lending partners and a large pool of investors that are still allocating capital. We've had to grow that pool of investors. And again, we've had to work really hard to get that capital in the door. Thankfully, we've got a lot of levers we can pull to
Make it happen.
deals quickly and continue to raise through our fund structure and our own balance sheet. We've got some capacity there. So, it's been really tough, and we've had to work different muscles. Whereas before, it was really hard to find a deal, and equity was relatively easily coming in. And these vintages, these years that we can buy when most people are hesitating or staying on the sidelines, historically have proven to be some of the best years to close on opportunities.
Yeah, that's for sure. And you mentioned your balance sheet. No matter what, the deal's getting done. It's just take advantage of the times, and they can invest later if you choose to let that happen.
Yeah, absolutely. And if if I were to go out there and say that I can close a deal and not close it, that would really affect my value in the eyes of the brokers and the institutional partners that feed us deal flow. So
Yeah,
one
100%.
thing you really want to avoid in this game is not doing what you say you're going to do.
For sure. And that's where a lot of people get tripped up, is they just don't do what they say they can't do or will do. That's
Yeah. And, if I had not started small and built brick by brick, I'd probably be still sitting around dreaming about doing big deals one day.
yeah, yeah. A lot of people want to be that person, and then they just like you mentioned, you have to grow in steps. Your brain has to get there as well. They just don't let themselves get there. But your partner, he's the integrator, you're the visionary. It sounds like.
Yeah, if you're an EOS fan, we are definitely firmly in those molds, very opposite, and I would very much classify him as a world class integrator.
Awesome. That's huge. And you guys can essentially be two different places at the same time, accomplish different goals, and it all rolls up to the top.
Yeah, we're rowing the boat in the same direction, and when it comes together, it's a beautiful thing.
Yeah, for sure. Very cool. What would be some things that you wish you knew then that you know now that would have helped save time or less ignorance tax you would have had to pay?
Oh gosh, paid a lot of tuition along the way, man. I
Yeah.
feel like I've made just about every mistake in the book. We've tried to outsource like equity placement from time to time by bringing in, partners that say they can bring us a lot of investors. That's failed almost every time. What's worked is treating current investors really well. They tend to refer folks, and that is still the second, excuse me, that's still the first uh, um, place source for new capital is referrals. We advertise. We've got our own internal sales team that's bringing people through the funnel. But yeah, internalizing things. We could go on here for a long time about all the mistakes we've made. I think what I'd point out maybe to the new aspiring entrepreneurs in your audience again is to take it slow and really focus on what's the next micro step, what's the next brick you can put on the wall, and maybe not worry so much about where you want to be. You want to begin with the end in mind, but then just keep rolling back to what do I need to do today to take one little step in the right direction, and then really get into the habit of that. Um, we've made mistakes where buying properties thinking we're going to improve the amount of cash flow. We've made mistakes buying, using debt that wasn't hedged with a rate cap. All kinds of things we can dive into. The list is long. I don't think there's any sort of manual for founding and running a business out there. You just got to do it. You got to know that you're going to make mistakes. Know that managing teams and managing people is much harder than the real estate, and it takes tinkering, it takes iterations, trial and error. But once it starts humming, it can start to grow this unstoppable momentum.
So for taking out the wrong debt, or at the time it's probably the right debt, but then things change in the economy and then it becomes the wrong debt. What are some, because this is good for the listeners, because again we're trying to help people from not digging their own trench when they don't have the head to get themselves out of. What would be some things that you would tell a beginning investor, beginning real estate investor, of what to watch out for, how to play it smart, play it different?
Yeah, the more you can learn about finance, the better. There's talk out there how floating rates are bad, or a bridge loan is bad, or this product is bad. They're all just tools, right? And you can use a hammer as a tool, right? You can use it to build a home, or you can knock yourself upside the head and end your life, right? And knowing how to use these tools appropriately. So floating rate can be a really great option for assets. Hedging that floating rate is critical. Having more cash on hand is critical. So what saved us is we've always kept more surplus cash inside the portfolio or a fund that we're constructing versus distributing it all or raising just enough equity to close the deal. We'd like to raise more than that and have surplus reserves above what the lender mandates. Having surplus cash at the portfolio or the property level for a given fund or a given asset can smooth out those inevitable bumps in the road. They're going to come from somewhere. Nothing ever goes exactly according to plan. At least I haven't seen that in my journey so far, over 9,000 plus units.
Got it. When you're buying the property, I mean, you want to buy it based on a cap rate and what the existing cash flow is. But there's times where you know that the area is up and coming and you need to buy at a basis that's uncomfortable, but you know you can get it there. I don't know if that's happened to you, but it was definitely the times in the past. But what would be I guess, some guidance you would give for someone who's looking to purchase, but it doesn't, it's a value add, and there might be different hiccups that you might be aware of.
Yeah, I mean, we're all in the value add game here. Real estate, if you're buying something that there's no value to be added, is a pretty mediocre return against other asset classes. So forced appreciation, value add is the name of the game in our business in this space, as it is in most real estate asset classes. What what my mentor said to me a long time ago was, I don't necessarily care what the cap rate is. I care more about what I can do to the asset. Having in-house management, knowing exactly what we can run something for, is very helpful there. So we can, basically take the seller's numbers and throw most of that non-controllable part of the P&L out and say, okay, what can we run this with using our maintenance teams, our management teams, our tech stack, our accounting solutions, and then what does the upside look like, right? At first, it comes to the market itself. What's been under rented? Can we take these rents higher as they turn over? Are there ancillary income opportunities that the seller hasn't fully utilized, right? And is the market itself, is it growing? What's the supply demand ratio look like both now and in the future? What's coming online as far as new assets, especially for us, because we're buying Class A mismanaged assets. So we're looking for those under or mismanaged assets in the Class A category. So those things have to be really important. Got to kiss a lot of frogs to find one that makes sense. But what's happening out there right now is only the folks that really have to sell are selling. And anyone else that can hold through this part of the cycle is typically holding. So the opportunities that are coming along are, what we're seeing are, in many cases, a little bit juicier than they have been in the past from an upside potential standpoint.
They're coming against maybe maturing debt. Their partners are starting to want to let it go, or their negative cash flow. What are you seeing most of?
Yeah, pretty much all the above. So what we're our typical targets the last couple of years have been either a large fund or group that maybe only owns one deal in that market. They've got a third-party manager that we have targeted as a mediocre management firm. They're a mom and pop operator that, sure, they thought they were going to sell it for more a couple of years ago, but now they're sort of capitulating to the market and they want to get their liquidity out. They want to go do something else. And then developers that are being forced to sell because they've got maturing debt, and their LP has said, "Hey, we're selling this asset for maybe a small loss just to get liquidity back." And those have been the scenarios that we're seeing out there that are offering or showing opportunities for what we target for our investors.
Got it. Very cool. What does your all's tech stack look like on the property management side?
Yeah, so it without getting into some of the secret sauce, we're always looking for ways to do more with less, whether that's through AI, through offshoring, through technology that makes us better at our job, and then comparing that with the current operating, the current operator, the manager, and what their expense load looks like. And so typically we're finding some economies in some of those areas as well.
Yeah, AI right now, new iterations come out of AI every day. So it's like you can invest now and it'll be outdated next week, or just be ready, because I agree. A phone call comes in and that can be handled by conversational AI right now, but you still need a person behind the scenes to make sure that things are still being directed where they need to be.
It's still a human touch game, and I think some folks are overcorrecting towards AI and thinking that they're going to centralize everything and fire a bunch of people, where at BAM, we're more focused on how do we make our people better at their job, more productive.
Mm-hmm.
then how can we fire people and just let AI handle it? So we'll see. The jury's still out.
Yeah, I think it'll enable a lot of growth because if you can still keep your high performing people in place and then uh, be able to ingest even more and give a higher level just customer service, faster ticket response, maintenance getting done, automated ticket closings, which a lot of this stuff can be done right now easily. It's just the difficult tasks being taken over by AI in order to then scale your company even doing more with less.
Sure. Yeah, I
So,
agree.
what kind of platform are you all running off of? We're at Folio. I don't know what you run 9,000 units off of.
Yeah, we just moved off of Appfolio. That's been a heavy lift, and we've been converting over to Entrata.
Okay,
Yeah,
okay,
so
that's
very
different.
excited to see the bells and whistles and the automations and open platform that we can add to Entrata versus Appfolio, which is a closed system.
That's
We
interesting.
were on we were on Appfolio for years.
Yeah, yeah, and usually, and
Josh, I lost audio there.
are you with me now?
Gotcha back.
Sorry about that. And try
What's
to
it
so
like
that's
being
just
live?
yeah, institutional grade CRM with I guess full ERP stack, and or are you plugging other pieces into it?
Well, so far, really, it's just getting Entrata up and running, and when you're converting that many units over, it's a full year-long process to get it all up and
Yeah,
running completely off of one onto the other. So it's anything but seamless behind the scenes.
yeah.
But I like the what I'm seeing so far from a business intelligence standpoint, the ability to bring in other tools and add that onto the Entrata platform. So jury's still out. It's still early in the game, but I'm pretty darn excited and cautiously optimistic. It'll be an enhancement for us for sure.
I think it's the business dashboard where you can start seeing around the corner. When those things start plugging in, different numbers start lighting up, different metrics and ratios. Um, that's where I think it can get really fun. It's still hard to finding an actual software that can bring next level analytics, plug in seamlessly into your current financials, and give you a clear vision. We've tried out a few, and I'm still trying to find that next level visionary dashboard.
Yeah, I hear you there.
It's but it definitely helps. What about underwriting? Are you still doing it manually on the spreadsheet?
Oh yeah, underwriting still guys rocking Excel sheets. Yeah,
Okay.
still rocking model via Excel for sure.
Okay. Cool.
Yeah, I don't think Excel goes away for us anytime soon from a modeling and underwriting standpoint. Um, you need that human in there that can recognize the data and have that fingertip feel when something doesn't look right.
Yeah. Yeah. No, I agree. Employees. So keeping them engaged, keeping them in the growth and the mindset, the vision. What are some things, some tactics that, because 9,000 units, keeping everybody rowing in the same boat, you have a lot of personalities to maintain, and personalities can clash. How do you keep that vision crystal clear for everybody?
Well, you said a mouthful there. It is a never-ending battle to grow and maintain culture. We get all the teams together a few times a year. BAMCon is coming up in October, which is our all-company conference. 2 days of education, communicating, big things to the team. Also, some fun and some social activities. But that's been something that just keeps getting better and better every year. The team just does an incredible job with bringing everybody in for our employee conference. We bring everybody back for a Christmas party every December. It's like a big blowout wedding / prom award ceremony. Everybody's dressed to the nines, plated dinners, no expense spared. We got an old school style corporate family cookout every summer, and quarterly events to keep folks engaged. And the day to day, we still use Slack. Microsoft Teams is a little bit too corporate for us. We like Slack. One of our core values. We've got a little bit of a fun, quirky spirit around here. We don't take ourselves too seriously, and so Slack's one of those great platforms that brings people a lot closer together when they're spread across 7 states now.
Yeah. We got everything operating off Office 365, and then we still have Slack.
Nice,
You
nice.
just can't replace Slack for some reason. Like you said, Teams just doesn't have the same deal. You've got everything integrated into one, but you just can't pull out of Slack. So
Yeah, Teams is a little bit maybe a little bit too straight laced for us here at
yeah.
the.
Cool. What would be some books that you would recommend to some of the beginning real estate investors out there?
Oh gosh, you got me. Got to go back in my file retrieval system here. So beginning real estate investors. Um, I don't read as many real estate books these days as I read biographies of folks that built big companies. Um, but I think if you're just getting started off in this business, you've got the classics everybody says, Rich Dad, Poor Dad. But there's a lesser known book called Robert Kiyosaki had like 15 different guest authors. I think it was The Secrets of Real Estate. Maybe you remember this one, but it
Yeah,
was
the property management, the tax, they all came together in one book.
it was one that he had a bunch of guest authors write about all different subject matter of real estate. So for the really early entrepreneur, still wanting to understand all the different ways to make money in real estate, that could be a really good one. Hats off. Kenny McElroy is a good buddy now. But his early books on property management and real estate syndication are still really good. Man, you're really on a Monday afternoon testing my recall here with
It's good to
early.
hear some different titles because it's there's a lot out there. But if you're filling your brain with knowledge, different books, different perspectives, it's just
Yeah,
trying to level
early
yourself up.
on. Yeah, early on, you need to read the real estate books. There's Maverick Real Estate Investing and Maverick Real Estate Finance. I hope I'm getting those titles right for your audience, but those are a couple ones that aren't brought up as much, that are also chapter by chapter, these different strategies in real estate and the folks that put those strategies to work, and sort of their backstory on how they used private equity or public markets and everything in between to grow a real estate company.
Awesome. Very cool. Ivan, we definitely appreciate your time today. If a listener wants to reach out, learn more about yourself, learn more about your company, possibly invest with you, how can they get a hold of you?
bamcapital.com.
Nice. Good deal. Definitely appreciate your time. I look forward to following you, and we will certainly talk soon. Thank you.
Thank you.